found it really interesting. These big capital projects in infrastructure just keep coming. What does that signal to you about what the market should model for in the coming years ahead?
Hi, Ed. Thanks for having me. I think the significance of this deal is that the demand for computing power is just insatiable. And remember when DeepSeek came out, a lot of investors were worried that actually there may not be the need for so much computing power if the modeling is so efficient, but actually that's not true. We see that there is high visibility of the scale of the investment by sovereigns, by hyperscalers, and many corporates. So I guess this is really the big conclusion is that the runway is still very long, and the incentive to invest is still very high. So I think the theme of investment in AI, particularly in semiconductors and cloud, which are the AI infrastructure, is particularly relevant.
Janet, in Brody's reporting, he's saying that this expansion between Oracle and OpenAI is 4.5 gigawatts worth of capacity. And in the context of energy, you could power this country at that scale. How do you think about the energy sector and the energy infrastructure requirements that markets are going to have to fund to support these types of data center expansion?
Again, I think the utility side, energy side of things goes hand in hand with the need for computing power. And that's why we have seen hyperscaler like Meta investing in nuclear energy, for example. So I think the quest for cheaper, more efficient energy would be there. And I think that is why I think the US will remain basically the region that would lead the AI race, because the US is basically self-sufficient in energy production, relatively cheaper energy compared to, say, Europe and, for example, the UK. So I guess that's a very important conclusion, is that there is incentive for companies to invest and base their production in the US to access its cheap energy base.
Janet, the story this Thursday is treasuries are falling, the dollar is stronger, and equity markets, particularly the technology sector, pushing fresh record highs on the NASDAQ 100. Give me your reaction to the jobs data and the eco print that we got this morning.
Well, I have to say the data is basically Goldilocks, because on one hand, you get better than expected jobs data. In general, a softening trend, but it's still okay, is still reflective of a solid labor market. Unemployment rate is lower. And at the same time, wage growth is actually slower despite a shrinking labor force. So I would say it's a Goldilocks, which market clearly likes. And I think the conclusion is that the Federal Reserve really is in no urgency to cut rates. But that's fine, because I think the markets would prefer the evidence of a strong labor market rather than fretting over the exact timing of a rate cut.
I do see some outperformance in technology. Why is that? Why is that? Is it just a weighting issue right now, and technology is what this market is? Or is there something in this economy and the path forward for the Fed that makes this sector more attractive right now?
Yeah, I guess there are lots of reasons, right? First of all, in terms of earnings growth profile, technology is still the brightest spot out there. As I mentioned, clear visibility on AI investment. I think, secondly, in terms of the productivity gains, I think the tech sector is likely to see or have a lot of those productivity surplus. And of course, I think in terms of the US market, I think the tech sector is where the attraction is. To access the AI theme, etc. And if we see, for example, rate cuts really coming by, I think lower bond yields, lower interest rate also particularly benefit those growth areas as well. So really a combination of factors.